So are we all in the clear now after last week's would-be reset on financial markets? Or does this still look a bit uneasy? That's the question that we're asking ourselves here as we kick off the second week of January with 2024 getting underway. Initially a bit soggy for the markets. This is Macro Money. Welcome. This is Ilya Spivak, head of global macro here at tastylive. It's an interesting conversation that we are presented with this week because not only did we have a very emphatic end to 2023, we then had a very lackluster start to 2024 that seemingly refused to build on last week's momentum, or last year's momentum, rather. And so as we looked at the way that markets evolved last week, lots of focus was on the jobs report that was coming on Friday and what that would mean for Fed policy expectations and for the U.S. economy more generally. We came to find out that the markets got a number whereby a choose-your-own-adventure kind of interpretation was there for the having. If you wanted to be optimistic, you could say, well, more jobs than analysts expected. This is good. The unemployment rate, a little bit lower than expected. This is good. Wages, still well supported. That's good. If you wanted to be pessimistic, you would say, well, the only reason the unemployment rate is down is because labor force participation is down. So it's not that more people found jobs, it's that a bunch of people gave up or exited the labor force for whatever reason. If you wanted to look at the payrolls number, you might say, well, the result was a little bit better than expected, but the prior 2 months were revised down to the tune of 70,000 jobs. So did we actually get a net increase? No. Looking at the sum total of what the numbers suggest over the past 3 months, we actually have fewer jobs to the tune of about 20,000 than we thought, despite the headline for December looking better. So if you thought the Fed was going to look at these numbers and think more cuts versus fewer cuts, you had your evidence, or at least what looked like it at first glance. And the markets predictably went nowhere. Seesaw action up, seesaw action down, and we ultimately end up static. Which, of course, raises exactly the question front of mind for us this week. Is the reset then concluded? Is what we saw last week, which pointedly failed to follow through once that jobs number came out, is that done now? And can we get back to our regular scheduled, generally optimistic, broadly well-supported dynamics that we saw in November and December? Or is there something else under the surface here? Is there more to go? So what we'll do here is we'll take a look at what all of this back and forth actually means and put some numbers around it, see what's actually moving it, and then take a look at the key macro waypoints that are going to influence the story this week. So first, let's have a glance at performance. This is what the markets did last week. Stocks clearly had a bad showing. Rates shot higher, strong gains for the 10-year, strong gains for the 2-year yield. So bonds were down and stocks were down. The yield and the price of bonds, of course, move inversely of each other. So seeing rates higher here on the flip side means bond prices were down. So stocks and bonds were down at the same time. Gold down. The dollar higher. We have that benchmarked here against the euro, 6E futures. You can see here down almost 0.9 That, of course, is the dollar's most liquid counterpart. So that exchange rate mostly encapsulates the direction of the dollar overall. And what we see here then is the flip side. The dollar was up almost 0.9% last week. Crude oil seemingly marching to the beat of its own drum here, really disconnected from the broader story. Still seemingly quite a bit of geopolitical risk in there, making its way into the price back and forth. Still some concerns about whether there's going to be supply disruption if the war between Israel and Hamas is going to expand. Perhaps some military action against the Yemen-based Houthi group attacking ships in the critical Red Sea run up to the Suez Canal. So lots and lots of sort of one-off factors in crude, disconnecting it for now from this overall story. But the message in stocks, in bonds, in rates, in the dollar, in gold, all very much telling the same thing. In fact, there's a kind of unifying narrative that screams out from all of this. You can see it here. In the gray bars is the expected path for interest rates this year. That's backed out of Fed funds futures. And what we see here is an increasing number of interest rate cuts factored into markets from late October, early November into the end of last year, being a major catalyst for stocks surging higher. And the peaking out of those Fed rate cut odds, so the gray bar is kind of rounding a bottom there, near about 1.5% in easing, then establishing a ceiling on stocks and a pullback. So that run up through November and December mostly, that seemingly gets a forceful pushback here in the first week of January. Now, whether that is because the markets feel like they've gone in one direction for an extended period and there's a need for a correction, but the main narrative remains intact, or whether that reflects a more deep-seated rethink of whether 6 rate cuts or 1.5% in easing really make sense still, if investors want to hold in their mind the dual ideas that we're going to get aggressive easing and a soft landing, seem to be at odds. Why indeed would we need very aggressive rate cuts if the economy is going to be generally landing softly? And if we are going to be getting all these rate cuts, is there a greater economic concern that we should be having? Perhaps it is the start of that kind of thinking. So far, unclear. But this seems to be at the heart of what comes next. And indeed, a very similar thing we can see here. As we say, this is a parallel narrative across a whole host of assets in the U.S. dollar. It declines as its yield advantage erodes with building rate cut expectations, and then rebounds as those rate cut expectations backpedal off their extremes. And this is where, again, the same question. Was this just position management at the first start? Was this just people coming into January saying, right, November and December, big runs, we didn't want to book them before, now we're on the other side of the calendar, there are tax advantages to booking them now, let's do that. But the underlying narrative remains the same, or markets are starting to sniff out that there is a greater inconsistency. in what the markets are seemingly saying all at the same time. And therefore, maybe there's more of an adjustment that is yet to come. Now, as it stands, this is the Fed outlook now baseline for investors. The first cut, all the way baked in for May, with about a 67% chance that we get it sooner in March. A second one is there in June, a third in July, a fourth in September. The fifth one is almost there in November, but fully priced in by December, with a 50% chance for a further sixth one, which incidentally is already there for January. And so the market's still looking for aggressive easing, albeit starting a little bit later than peak speculation. That honor goes to December the 27th, where the market saw 6 cuts fully baked in through December, with about a 40-ish% chance for a seventh, which is an absolutely blistering pace, implying that out of 8 meetings in an election year, no less, where the Fed isn't going to want to appear to be meddling with the political cycle somewhere in the second half of the year, in particular in the fourth quarter, we have a situation where all but 2 meetings and maybe all but 1 have cuts. Unless, of course, the Fed opts for a jumbo 50 basis point cut at one point. That's obviously a very emphatic perspective. It starts to make sense why the markets might backpedal from that, at least at the start of the year. This is where we still are. So the setting is still very, very dovish. It's not quite 6.5 cuts dovish. We've shaved off about 1 cut so far. We're at about 5.5 now. So 5 cuts in, 50% chance of a sixth. But nevertheless, this is a very, very dovish perspective. And so this is then the premise we continue to test this week, to see if there is continuity and what it is continuity of, November and December, or last week. Needless to say, the absolutely most critical release that stands out this week, at least to my mind, is December's U.S. CPI report. Here, the expectation is for generally fairly moderate results. The Fed, of course, cares most about the core reading, and that's expected to edge down from 3.9 to 3.8% year over year. The headline is seen coming up a little bit from 3.1 to 3.2. That's probably the influence of crude oil and gasoline. As we can see, goods inflation has been squeezed to essentially nothing. All of the stickiness in inflation still lives in services. And energy has been a kind of volatile influence on the downside, shaving off a little bit more or shaving off a little bit less over the recent months, depending on what the price of oil is doing. So at the moment, it looks like maybe the price of oil will give us a little bit less of a disinflationary influence in December than it did in November. And if that's the case, then perhaps we account for what's going on at the headline. I mean, if we consider here, crude oil was down 6.25% in November. It was down a relatively smaller 5.6% in December. If we look at the situation with gasoline, which is another major consideration here, especially at the consumer level, the pace of monthly declines has been slowing essentially since October. And so what we're looking at here then is maybe a diminishing influence from energy on the downside of inflation, and thereby perhaps accounting for that slight uptick at the headline. But there's not very much that the Fed is going to do about global food or global energy. Those prices are set on global markets. Not a whole lot the Fed's going to do to discourage people from using energy or eating, as a matter of fact. Not exactly a strong substitute set of goods there. And they're not exactly optional or discretionary. So there's not a whole lot that interest rates rising to cool economic activity that is going to materially alter this. Of course, more impactful on energy than it is on food, but there isn't really anything the Fed can hope to do here in a direct way. Rather, it is the service sector where the issue still lingers. And the fact that we're going to get perhaps a downtick in core, which is, of course, the bulk of where the service sector inflation situation lives, that's encouraging and may inspire a relatively positive perspective. As it happens, U.S. economic data has tended to hew increasingly close to forecasts. This is the Citigroup Economic Surprise Index for the U.S. It measures U.S. data outcomes relative to forecasts. And what we see here is we're hugging the zero line, having been well north of it for much of the second half of the year. In fact, we began to adjust down in that direction right around August, as U.S. economic data basically started to speak to an economy that was relatively staid for the subsequent months. In fact, we haven't really gone faster or slower on U.S. growth since August, giving markets ample opportunity to adjust expectations. And indeed, we can see that in that time, U.S. economic growth forecasts have increased. There's the 2024 reading there. As we can see, 2025 is far enough away that nobody is really actively moving those expectations just yet. But the outlook for 2024 certainly was notably upgraded from right around August into the end of last year. That, of course, means that the bar was raised on economic data, so it isn't surprising, really, that it has had less and less capacity to surprise on the upside now that the bar is higher, and also suggests that because things haven't really moved very much, once those expectations increased, the numbers expected and realized came closer into alignment. So with that in mind, we probably get a CPI number that's fairly close to expectations. That doesn't break new ground on Fed rate cuts, but likewise, it also doesn't necessarily negate them, nor suggest that the market is inherently wrong, at least for now. So the upshot of what's going on here, which is an aggressively dovish shift in Fed policy expectations from the start of November, that basically holds. You can see here in the big dots here is where the implied policy path was following November's FOMC. Then there is December's FOMC, overtaken by the current curve, which sits right on top in the solid. And we can see here that markets have done very little to keep the Fed story going since the December meeting. It was really November's meeting into the December one where the Fed started to pivot into a more dovish direction after a very hawkish September meeting. That's where most of this adjustment has occurred. The data since December's FOMC hasn't really done much of anything. The market seemed to take that meeting almost as confirmation of what was hinted at less overtly in November, kept running, of course, as we've just seen on the chart of stocks relative to rate cut expectations. That's this right here. We can see that in December, there really wasn't a whole lot of extra ground that was covered. The bulk of this was here. But needless to say, that did not prevent stock markets from roaring higher. So if that's at all instructive for how this goes, then numbers relatively in line with expectations on CPI may give a further lift to risk assets, may lift stocks, may lift bonds. If only in that they don't make Fed rate cuts less likely at the scale that the markets have them. And of course, if there's an upside surprise on CPI, then stocks look vulnerable, bonds look vulnerable. The dollar probably looks like it has legs to keep going higher. Now, aside from this story, there are two more interesting indicators that are coming to us this week that bear mentioning. And the first one is a little bit of a wild card because it comes not necessarily from the world of macro, but it could be an interesting indicator all the same. Just before that CPI number comes out on Thursday, there is a deadline on Wednesday for the Securities and Exchange Commission, the SEC, to issue a ruling on a bunch of applications from various ETF publishers, most notably BlackRock. That's the one that gets seemingly the most mention in the coverage, for a spot Bitcoin ETF. This would essentially be a little bit more of a cost-efficient option than the current funds options. You can, of course, at this point, do a stock market-based exposure to Bitcoin, but it would not be as capital efficient as an ETF. These are more like a more expensive structure. And so what we have here then, and of course there's futures, needless to say, and then there is owning the coins outright. The speculation seems to have been that owning the coins outright is too complicated and too strange for mass adoption at the retail level, that there is a cost structure improvement here relative to current stock market-based exposure options, that futures are large contracts and perhaps out of the level of expertise or purview of most financial advisors, but ETFs are not. So financial advisors that would want to introduce this into the asset mix for kind of very classic portfolio allocations for things like pensions, for things like run-of-the-mill retail investors, just looking for a long-term allocation to crypto as an asset class, that this would become a sort of usual part of portfolios. And that what this would do is drive upswell in capital into Bitcoin and drive Bitcoin higher. Now, as it happens, we have here a Bloomberg tally of the mention of the phrase Bitcoin ETF in news stories that they aggregate right alongside the price of spot Bitcoin. And what we can see is that from about the middle of the year last year, there's been a wild build in coverage of this. And that probably comports with more rampant speculation that then boosts the price. But of course, the question is now, if that approval comes through, as is widely expected, is there then immediate buying? Do you get the inflow right away? And if you don't, have you already done all the speculating on the event risk itself, with the price being so high, and the chatter being so loud. And so is there then a buy the rumor, sell the fact sort of a dynamic where Bitcoin actually falls after this news? And if that's the case, what does that say about risk appetite for retail investors and the financial advisors serving them? So this could be a bit of a cooling effect on markets, but of course the deadline is a day before CPI, and so follow through might be limited at least until after the CPI numbers come out. But this could color things somewhat. Speaking to the idea that if Bitcoin rips higher on this news, then the market is very, very keen on buying risk, and perhaps then the Fed needs to do more to cut rates because it hasn't beaten investors badly enough. Whereas if Bitcoin significantly declines on this, then perhaps the consumer isn't interested in taking on risk. And perhaps that's a negative story about the US economy and about the need to cut if you're the Federal Reserve. Bit of a out there indicator, but something to watch certainly as an overlay for everything else that's going on. And finally, speaking to cyclical concerns, there is a raft of economic data out of China. Notably, the situation in imports and exports looks like it's going to be broadly static. A little bit better on exports, 0.9% year-on-year gain expected there. Still anemic on imports, down 0.5%. That's a little bit better than the decline of 0.6% in November. But nevertheless, doesn't seem to suggest that things are going very far, very fast. Export growth still very weak in historical context, and import growth still anemic, relatively speaking. And as we can see, both of these things have been moving lower and haven't really picked up momentum to trend higher, speaking to generally weak conditions in China's economy. But this is probably not the most eye-catching piece of Chinese data on the week. It's probably the inflation numbers. Here, we are looking at continued disinflation to start and deepening disinflation to make things worse. As a matter of fact, disinflation isn't even the word. Deflation is. Because not only are prices not growing, they're shrinking faster. And that is, of course, bad news for the world's second largest economy, but also a referendum on demand from its main external customers. When the price for things, both at the consumer and the wholesale level, is falling, that speaks to anemic demand. Things don't go on discount because people want to buy them. They go on discount because people don't. And the price has to be cut to try to entice them back into the market. So to see deepening negative numbers on CPI and PPI all speaks to the idea that demand in China's economy remains broadly absent, which is, of course, terrible news, not only because China is the world's second largest economy and a major contributor to the global growth story, but because China remains at the center of the global supply chain and depends on demand, largely, on doing value-add work where it takes in raw and semi-finished materials from elsewhere, makes them more finished or finished, and sells them mainly to the US and Western Europe. Western Europe is, of course, already in recession, so demand there, or almost certainly at this point, and demand there is understandably weak. Deepening deflation here would suggest that demand from the US is not all that wonderful either. And that, of course, isn't just bad news because China is weak. It's bad news because demand seemingly in all three engines powering 50% of global growth and then some, because most of the other economies are vendors to those three and depend on their demand, that's not looking good either. And so all of this perhaps revives worries about some sort of a global recession becoming increasingly inescapable. And as it happens with China, as with the US, the pace of economics surprises relative to realized outcomes has steadied, where again, there is convergence. So the likelihood that we get numbers relatively close to forecast seems generally high. You put that together, and what ends up being the takeaway for your week is the Fed has reasons to cut. Inflation is going their way, so the dovish bias makes sense. But perhaps the risk appetite and growth story looks scarier because of what we might get from China, certainly, and perhaps also as a response to this Bitcoin ETF saga. All of which perhaps comports not necessarily to the kind of situation where stocks cheer, though rate cuts look sensible, but perhaps bonds do. Because maybe finally we are looking at a situation where the market is thinking less about cheap money on the horizon and more about why cheap money is on the horizon, which is, of course, a story about a global economy that is going to have a very hard time avoiding a coordinated recession in the months ahead. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, talking about what happened on Wall Street on a given day and where things might be going next. I'm back on with Chris for Futures Power Hour on Friday, writing for the News and Insights section of tastylive.com, on with Tom and Tony for First Call on Sundays, and opining on the platform formerly known as Twitter, at Ilias Pivac. Thanks very much for joining. Macro Money will be back tomorrow. Happy trading.